Hello, everybody. This is Jim Cook, Certified Financial Planner, bringing you a quarterly investment outlook update. In the past, I've sent out videos a little more intermittently, but I've had a lot of requests from my clients that say, Jim, can you give me a pulse of the market? In your opinion, can you give me a pulse of where you think things are and where they might be going? I'm not talking about using this information to trade in and out of different investments, but rather, what's the gist of what's going on? Help me not have to listen to media and filter the stuff myself. So that's what we're going to do today. Right now, we're in a very interesting time. I'm very happy for the fact that the stock market and bond markets both went down last year. Yes, I said happy. Am I happy because my accounts or your accounts may have fallen some? No. But I'm happy because we are entering a period where we can get out of this crazy free money zone, like the Fed's like, make it rain, and people are all partying, and into something that's more responsible and normal. Because in a shift to responsible and normal, we can actually develop a little more predictability as to how returns might look in your portfolios across time. Now, what are the major factors that are at play? We had a lot of interest rate increases by the Federal Reserve Board last year. And even though right now they've been kind of shrinking down and tapering that off, as Jerome Powell said things like disinflation, meaning we still have inflation, it's just not going up quite as fast as we thought. Meanwhile, he's saying this at 6.5%. And if you try to buy eggs or meat or what have you, you'll probably not think it's only 6.5%. Keep that in mind. But his sense is we're starting to shrink that rate of change. The Fed always wants some amount of inflation, but they'd like it to be in a sweeter spot. They say 2%. We'll see where it gets to. So that's one. Two, we have interest rates now going from almost zero at let's call the short-term range. Think savings account, for lack of a better example. Savings account rates go from almost zero, and now they're sitting up at 3.5%, 4%, give or take, as of the time of this recording. That changes some things too that we're going to get into. Now, three, you have a stock market that has some areas where the stocks or companies therein seem to be more fairly valued after having perhaps dropped a bit. You have other ones that still seem to be somewhat highly valued, and you have a myriad of options to say, hey, where do you think the economy's going or where the stock market's going from a whole bunch of pundits right now that's all over the board. I have seen reports so far that say stock market will crash more than 10%, 15%. On the other side, I've got some saying, hey, everything's great. Stock market's going to be up 10 to 15%. I need to give you a simple truth before I move on. They don't know. Nobody knows. Their crystal ball is just as cloudy as our crystal balls. So I believe in the facts and simple math, and that's what we're going to stick to. So in the stock market, that item 3, we have mixed signals about where things might go. What about the bond market? If the Fed keeps raising interest rates, what happens if they go increase, 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 right? They might be small, however, they add up, and that can still have a potential negative effect on the bond market. Although, with higher interest rates, that may make it less of an issue. The next item, number 4, the housing situation. We've seen housing rates and rent rates sail up. Like, what the heck is going on? You'd be like, why is it that houses are so expensive right now? And they would say, wait, it was the pandemic. Everybody wanted to move somewhere different. And so there was demand. And here we go. Well, partially true. People did break the normal geographical bounds and we saw more movement. However, the demand side has really been there. Like people said, why not own a house? And part of that was due to lower interest rates. If I can get a mortgage for cheap, I don't have to put as much money down. I can buy more house. Is it always best? Not necessarily, but it's what was. What is right now is higher mortgage rates. And if you complain that 5% or 6% is high, let me tell you that historic norms should be around 7 to 9% on average. 7 to 9. So we're still technically low. but we're a lot higher than where we were before, almost double. And that creates a little shock in the system. So what we've seen is home sales have petered off. They pulled back. And then when the rates dropped a little bit, they kind of picked up a little bit. But what do I think about housing overall? Well, we still, regardless of the situation with rent and price increases, we still have a very high demand and a lower supply of houses. That should push or inflate the prices of both rent and house prices across a period of time in the future. Unless we see that demand shift, I do not see that changing. That's an inflationary pressure. Now, how about for number 5, wages and employment? We see unemployment as a new record low since the 1960s, 3.4%. And people think, yay, we should get unemployment to 0. And I'm going to be like, no, you should not. And here's why. There's a healthy balance between roughly 5 to 6% of unemployment where neither the employee nor the employer is favored. If unemployment's really high and there's a lot of people looking for jobs, the employer can say, well, heck, I've got a stack of resumes. How about I give it to the person that wants a little less? And they can kind of cheat down wages a little bit or give less benefits. If we go to the flip side where we are right now, we have not enough employees to fill too many roles. This means that the employees have multiple job offers and they're basically like, who's going to pay me more? It's the opposite end of that teeter-totter going on. And in that situation, you have the employees taking advantage of the employers. In the other one, the employers can take advantage of the employees. Well, when we sit around this 5 to 6% unemployment, normally it's kind of in balance. And that tends to be a safer, more stable spot. So right now, the Fed's been raising interest rates, stock market dropping, some houses pulling back a bit. And yet, unemployment's been crazy strong. The January jobs number surprised people so much, once again showing that they're just predicting like you and me. Doesn't always mean that they predict better. So initial expectation, 188,000 comes in over 500,000 added. Now, that to me is a big miss. 2.5 times miss. Huge. It's like you were aiming for the bullseye. You weren't even in the rings if you're shooting archery. But that is a testament to the fact that our job market is robust and that there's still demand for people. Even though you might hear of some layoffs in the tech industry, by the way, minuscule, compared to how many people were hired from the pandemic time to how many were let go, it's like really, really small. So we're not seeing massive layoffs in any way, shape, or form. So that demand means that wage inflation is likely going to continue. When I can go out and say, who wants to hire me? And I've got a bidding war for me, I'm taking higher wages. Higher wages tend to be the stickiest of all inflation types. I mean, who wants to have said, I worked for you for a year, and you go into your boss and you're looking for your yearly review and they say, congratulations, Jim, you've done awesome. You're going to get a 3% pay decrease this year. People are like, what? That's crazy. They'd get up and walk away. And that's the point. If they would get up and walk away and leave, it makes it kind of hard to shrink people's pay. Now, some companies will lay some off to shrink payroll or the sum cost of all the wages, but it's extremely rare when you'll say, we're going to give you a pay cut and you're going to like it. Normally, you'd have to have almost a depression type situation. We are far from that. So we have an inflationary aspect from housing as well as an inflationary aspect from wages. That may make, back to number 1, the Fed's job harder. I have a feeling that many people say, and inflation went down by 0.5% this month and 0.5% that month and 0.5% this month. It'll just keep doing that like a straight and perfect line. And I will tell you that nothing in economics behaves like a straight and perfect line. It's zigzags and pulses and starts and fits. It behaves functionally like the mind of a teenager. Sometimes it's happy, sometimes it's not. Sometimes they're just blasé, like, and you don't know why, and it doesn't always line up with when they should be happy, sad, or indifferent. That is how things will progress. Perhaps inflation going from 9 to 6.5 is going to be a little harder than going from 6.5 down to 2 or 3 or whatever number the Fed chooses. Maybe we'll see inflation persist. If we do, Fed will likely, if they do what they've said, continue to increase those interest rates. Now, what would I love to see? And this is in my personal opinion, I would love to see that the Fed goes in back to almost what they were doing in like the Alan Greenspan times. They say we're going to make tweaks up and down. You see, since roughly the whole financial crisis time of 2008, it became rates went down, and then they were down for a long time. They started to go up and then boom, down, and then they went up and then boom, down. And so only now have we seen this spot where we went up a lot, relatively speaking, not actually a lot, nothing like the 80s. We had this increased change up here. Will it stay? If it stays and we start to become less always on or always off, I believe that's actually a good sign. It's in my opinion, fiscally responsible thing to do when it comes to managing interest rates, because it means that we're now in a spot where we get to fine tune things. We don't have to make gross, sweeping movements that have larger potential consequences, like stock and bond market both being down double digits in 2022. So as we are looking at this weirdness, the interest rates get the media attention. This is what is driving the eyeballs. But what is also happening behind the scenes is something called quantitative tightening, which is the opposite of quantitative easing. There are two ways that the Fed generally controls the monetary and fiscal policy of the United States economy. One of them has to do with interest rates. And by the way, there's an argument. People say, look, it's working. Inflation is down. I'm like, how do you know it's down? What if mortgage rates just went up a little bit? Well, they went up because of interest rates, did they? What if a supply demand hit? It's a little more complicated than that. It's not a simple cause and effect. But the other side is whether or not the Fed is putting money into the system or taking money out. The more money they pump into the system, the more money can move around. That is like the economy wheels rolling. But if the wheels start going too fast and it feels like we're in one of those little wagons and we're going to like, oh my goodness, I'm going to spill. That's when inflation is getting out of control. The Fed's like, we want to put the brakes on and try to say, let's slow it down, go the opposite direction, try to take some of that money out. That started happening in the back half of 2022. And it's still happening now. And if you looked at a graph of where the Fed's balance sheet, how much money they have basically put into the system by buying stuff, saying, hey, I'll buy it. In order to buy it, I have to give you money, right? Well, that's what they're doing with the economy. If you look at this graph over time, it was ticking along like nothing. And then came 2008, and we see this big boom up. And then 2020 and some other, and it just over time, wham, wham, wham. It's disgustingly high. And that is a lot of money to bake off. That's a wild card for me right now because even though it's not getting press attention, it's something I'm watching, something that I'm observant on and saying, what effect will that have? Now, if the wheels of the market are turning at a pretty good clip anyway, a little brake pressure just slows it down and we don't even really feel it. That's okay. And if that can happen, then you would get a result, at least in terms of interest rates, of what the media is calling a soft landing from the Fed. Never mind that it's never been done before because everything is impossible until it's not. Note that they're saying, can we in fact slow the economy down without the economy stalling, which is a recession? A stall is where we're like, oh, shoot. It's like now we have to be shrinking. We don't have as many people buying things, all this kind of stuff. I personally think it's going to be hard to stall the economy given the demand in that housing spot, people still wanting to buy houses, and the fact that inventories are way low compared to where they used to be historically, way low. Since 2008, they used to be up here, and now they're down here. And even with the increase of buildings, it's still way behind demand. That's one thing that'll help those wheels keep turning. The other is that wage inflation we talked about. More money in people's hands. If you're an American, you're a consumer, and consumers spend money. My job is to try to help people not spend too much, keep more of it so you have it for later, keep a healthy balance. But man, are we good at spending money in all sorts of ways. And when we have excess, Parkinson's law states that our expenses will always rise to meet our income unless we take effort to push that down. For many people, they take no effort whatsoever, and they ride with this as a tide. And that's why they're always a little short or think they're doing okay, even though they could be woefully unprepared for what's coming in the future. Well, that is what I'm kind of banking on. The fact that the vast majority of the United States is going to say, if I got extra money, I'm going to figure out a way to burn it. Why save it? Even though savings account levels, you may say, are a little bit higher now, I'm talking about behavioral patterns and spending patterns with money. And if they keep spending, guess what? If that outpaces supply and demand is higher, that's inflation. Inflationary pressure is right there too. So I do believe that the 9 down to the 6 or 7 range is an easier run than what can happen afterwards. But if I look and say, crystal ball of Jim, oh, what do you predict is when we might be okay with inflation? And remember, my crystal ball is fully as cloudy as everyone else's. So this is not any type of guaranteed promise or anything that you should act upon. It is purely academic. Here's what I would think. I think that if we were to track the money supply, all the cash that people have to spend, and when that gets back in line to what it has historically been, right now, that intersection looks like it might happen in 2025-ish, all right? That's still 2 more years from now. Now, does that mean that we would have inflation that's 6% for 2 years? No, I don't think so. But what I'm saying is that we may have the actions to push those wheels of the economy forward. That's kind of an impetus behind it. Money, like water, finds its own level. It wants to be spent. It's what it is. That's why it's so hard to save. That's why the Japanese have that saying that basically says spending money is like pouring water over sand. Phew, there it goes. But saving money is like digging in the sand with a pin, like a little pin, picking up little grains of sand. It's something that requires effort and focus. It's not our natural state of being. So all of this round picture, you can see that there are multiple things, and we haven't even talked about the international aspects. I'll save that for another video about what can affect the economy. I believe right now we have a lot of counter forces. It's a strange time in history and fascinating. I love it. For each negative, we tend to have an opposite positive. You say, well, here we are raising interest rates, and they're higher, and that should slow down the economy. And I say, yes, but unemployment is low, and it's going to keep the economy going. And you say, well, housing prices may be dropping, and they are pretty high, and it's harder to get a house. And I say, yes, but you have a huge shift where there's not enough houses in supply to fit the demand. Even if the demand pulled back, there's still enough to bring them on. So you start to see these counterpoints all over. It creates a mess to try to predict. So you're going to hear a lot of predictions on the news or what have you, if you're even bothering to watch that. And I will tell you, take them all with a grain of salt. Because in the end, somebody's going to be right, somebody's going to be wrong. Nobody just knows which one of them is going to be right or wrong. Which is why, in investing-wise, I follow a very strict process that has to do with the time of when you need the money, the anticipated risk exposure with that slice of time to give you staying power if and when we have market pullbacks. All that being stated, know this. I get really happy when the market drops for 2 reasons. 1, it shakes out the gamblers. It gets people a reality check. It says, hey, this does not go up forever. And if you thought it did, as it's done functionally since 2009-ish, if you thought it did, welcome to reality. It can go down. It can even go down multiple years in a row and has done so relatively recently. Anticipate that. I am when I'm making investment decisions for your portfolio. Now, the other reason I'm happy when the market goes down is when it is just raining in the market, sometimes good stuff gets wet. And if somebody said, I don't buy wet stuff, they pass up good things that might be on sale. And that normally sows the seeds for the next period of growth. And those growth periods tend to be, historically, longer than those downward periods. Why? because people want the market to go up. Like, no one just doesn't want the market to go up at all, or say, hey, go down until it goes away. Like, they don't want that. And since people want things to go up, enough people want it, it'll go up. It's the way it works on a simple psychological level. If you've got any questions based on the information I've presented, which some of which will be echoed directly in our conversations and meetings, I want you to reach out to me. Let me know. I'm happy to go into these points and down that rabbit hole as deep as you want to go. But hopefully this little bit longer form video will help give you an outlook that I plan to put out each quarter, give or take. Sometimes travel may make it harder for me to do so exactly on the quarter, so flexibility is appreciated and one of the great spices of life. In the meantime, be well, and remember, we're probably in for some choppy up and down stuff. Even if it looks like things might be going up or down for a period, do not be surprised if you see reversals, some I don't know which way I want to go positioning. And I think a lot of that depends on the economy. Do we end up heading into a recession as a whole in the economy? How about the Fed and the interest rates? How high do they go? What does that mean? And are people still going to be buying houses, or can I get money to borrow for things? And are companies' earnings actually going up, or are they trailing off? And regular companies, not just tech companies, need to be downsizing and laying people off. Okay? Those are the things to look for. Right now, I don't really see a lot of supreme danger in any of those spots, but they are trends to be aware of. This has been Jim Cook giving you your quarterly investment update and outlook. Hope to talk to you soon.